if you're looking for a solid dividend stock, I think Shell is a pretty good option for that. You don't have crazy share price growth. It's only up 5% over the last 5 years. So basically you're flat. However, the forward dividend yield, the yield is 4.5%. That's pretty solid. Now, I would probably want the share price to match inflation if we're getting yield around 4.5%, because you can get something like Schwab Dividend ETF, 3.5% yield, and then you're going to much outperform inflation, at least over a long time horizon. I think there is evidence, though, that Shell dividend yield will be higher some point, hopefully in the near future as well. But we'll dive into that in a little bit. If we zoom out here, since 1997, we're up a little bit, basically flat, but we can expect it to have peaks and valleys, but somewhat hover in this 50 to 65 range. Maybe you can buy in lower, sell when it's super high, but oil, they're an energy stock, so they primarily offer oil. There's always going to be times where it's up and it's low, like during COVID when no one was driving anything anywhere. Obviously, oil and energy stocks were significantly down during that time frame. That really isn't super surprising. And we can look at PE. PE's low, Ford PE 7.5, PE 12.5. Sure, it's cheap as well, but if there's going to be a big recession, probably everything's going to be hit. So it's not like a crazy diversification stock. Revenue, we're up a little bit, maybe flat. Well, we're up a lot from lows in 2021. We're kind of flat here. But what I'm most interested in specifically is the dividend. And we can see it was back in 2016 to 2019, area 3.76 dividend, and it was pretty consistent. It wasn't anything crazy. Since 2020, it dropped down to 191. Obviously not very high. Actually, in 2021, it was even lower. 2020, 2021, 164 even. And that's why you see such a big drop off. Obviously, like I mentioned, the energy stocks were getting hit really hard. Price of oil was down dramatically. We can see it recovering to 198, 247, 275, and we can probably expect it, hopefully, to get around 376, even if we're conservative and say 3.5, and the share price runs roughly the same, because that's where it was in this time frame, maybe a little bit higher. We can expect, a higher yield, probably in that closer to 5.5, maybe even 6% range, and then we're talking, okay, this is a stock that you're fine if it doesn't match or beat inflation, as long as you're getting 5.5, 6% yield. So I think this might be a quote-unquote buy low opportunity for that, and then eventually you'll get a stock that's paying closer to a 6% yield long term. Schwab agrees with that idea, not that I'm endorsing that or saying you have to do it, but Schwab really thinks this is going to be a good company performing over the next year or so. I think that's how they do the rating. They give it in the top 6 percentile of all stocks. An A, that's a very good rating for Schwab. They generally do not give ratings that high. So they think there's something here at least. And I just real quick, I want to touch on, oil, natural gas, specifically oil, obviously electric cars, things like that. People are concerned about being phased long-term and probably in 30 to 40-year time horizon, maybe even a little bit lower than that or a little bit longer, depending on where you're at. Yes, people are trying to phase out fossil fuels and similar stuff. However, at this point, at least in the next 10, 15 years, it's just probably not feasible to have it phased out that quickly. Electric cars really aren't selling that well as of today. Things change over a long time horizon. People are really expecting people to change to electric vehicles really quickly. Doesn't seem to have happened as people think. But over the long term, you got to be wary of that and don't be afraid to sell, to take wins on stuff. And also, I would not have too much of my portfolio specifically in oil and natural gas. However, some of it completely fine. Certainly is a long time horizon. You'll probably get your dividend. You'll probably make your money. You'll probably be fine. But I did want to touch on that because that is something that comes up on it. Non-economic mode is a little weird. You'd think it'd be closer to narrow, but Morningstar, I disagree with them sometimes. 4 stars, 4-star buy, avoid, buy. Moderate weighted key issues, ESG stuff. It's not an American company. If you're non-American, I believe they're European. I'm trying to think the exact place. I don't want to sound dumb, but okay, Royal Dutch, and then United Kingdom. So it's European. So if you're European, it's not necessarily a disadvantage. It might be an advantage because it's easier for you to get, but there might be some ADR fees if you are American and you're buying this, but they really shouldn't be too crazy either. In terms of PE, disregard PE. Mostly what we're concerned about is Ford PE for a stock like this because there's weird things that happen in the short term. Ford PE right in that normal range, actually pretty on the low side, 7.67. So, and you bounce in that range of 7.6 to 8.6 over the last year and a half. So this is pretty normal. Shouldn't be that surprising. There hasn't been any crazy increases or decreases. And you are getting 11 of the 15 analysts saying buy. That is a pretty good rating. Usually you want about 2/3 for a growth stock. And then for stocks like this, which is more value-dividend, you usually don't get any strong opinions on buy. So the fact there's this many people saying buy is actually something to note positive of. Maybe there is definitely some short-term opportunity for it to run. I'm not smart enough on that specific field. I don't really know how any stock is performing, but we are near 52-week lows. So that's something to consider. But anyways, I appreciate you for watching. If you enjoyed, like and subscribe. I'll catch you next time.